Let me ask you something, and I want you to sit with it before you scroll past this video. Where is the God candle? Where is the explosive move retail was promised the moment the Clarity Act markup passed? Where is the parabolic breakout every influencer on this platform told you was inevitable the second bipartisan support hit the wire? You felt it building? You watched the price push from 151 up toward 155 with clean momentum. You saw the breakout above key resistance. You felt the rush of, this is finally it. And then, silence, pull back, retest, consolidation. The chart started drifting back toward the lower exponential moving averages and the liquidity zones that had been acting like magnets the entire previous week. And the moment that drift began, the same retail audience that had been screaming, "We're going parabolic," pivoted to, "The thesis is broken." Strong claim, I know. But before you scroll past this video, ask yourself this brutal question. When in financial history has a major regulatory event ever produced an instant, clean, vertical breakout without a retest? Not in 1996. Welcome back. On this channel, we don't trade hype, we decode structure. Today, we are going under the hood of the most psychologically destructive phase in any regulatory cycle, the pre-confirmation interval between progress and finality, where retail expectations get crushed against the reality of how institutional capital actually behaves. No moonboy fantasies, no emotional charts, no comfortable lies dressed up as analysis. Just the legislative mechanics, the institutional behavior patterns, the technical structure of the consolidation, and the discipline that retail has been systematically trained to abandon at exactly the wrong moment. Before we go under the surface, this is informational analysis, not financial advice. Let's jump in. Let me give you the legislative anatomy with the precision that retail content has been refusing to deliver. The markup vote that just passed is the committee-level endorsement of the bill's framework, not the bill's final language. Right now, multiple versions of the Clarity Act exist across different committees. The Agriculture Committee version, the Banking Committee version, each with its own emphasis, its own constituency, its own protective language. The next stage is reconciliation, which is the formal process of merging those versions into a single bill that can survive a full chamber vote. Reconciliation is not a procedural rubber stamp. It is a negotiation where every interested party, Democrat, Republican, pro-crypto, anti-crypto, ethics-focused, innovation-focused, fights to preserve the language that protects their priorities. Ethical guardrails get added. Innovation protections get debated. Consumer protection language gets sharpened. Compromise gets engineered in real time. And every round of compromise adds days, sometimes weeks, to the operational timeline. This isn't a prediction, it is the documented behavior of fixed supply assets meeting deferred institutional demand. If you have a problem with these numbers, you don't have a problem with me. You have a problem with the math of how regulatory transitions actually unfold in markets that depend on compliance-bound capital. Let me sharpen the point even further. The market right now is performing three simultaneous functions that retail almost never decodes properly. Function 1, emotional overshoot absorption. The run to 155, priced in optimistic outcomes faster than the underlying legislative reality could deliver. The market is now correcting that overshoot. Function 2, liquidity sweep. The pullback toward the lower exponential moving averages is generating the order flow required to fill the inefficiencies left behind by the rapid impulse move. Markets are constantly seeking efficiency, constantly returning to retest the zones they skipped during emotional moves. Function 3, base building. The consolidation around the 50 EMA region is establishing the structural foundation from which the next expansion will launch, whenever that expansion actually arrives. All three functions are happening simultaneously, all three are necessary, all three are being misread by retail as evidence of weakness when they are actually evidence of disciplined market mechanics operating correctly. Now, let me destroy the most damaging psychological trap in the entire crypto market: the binary thinking that defines retail interpretation. Retail looks at the chart and demands a binary answer. Is it bullish? Is it bearish? Is it going up tomorrow? Is the thesis broken? Markets do not operate in binary states. They operate in probabilistic states. The current chart is structurally bullish in the medium-term framework, as long as price holds above the 50 EMA region. That conditional statement is not a prediction. It is a probability framework. If support holds, the broader uptrend remains intact and consolidation gives way to expansion. If support fails decisively, the structure shifts into a deeper correction phase, where the market searches for lower liquidity zones before attempting recovery. Both outcomes are possible. The relevant question is not which one is guaranteed, but which one carries higher probability based on observable conditions. And the observable conditions right now favor base building consolidation over structural breakdown. While retail is panic selling and demanding God candles like they're owed one, the institutional signal has never been louder. Look at what is actually happening, not what is being broadcast on social media. Ripple has spent the last several years deploying over $3 billion in strategic acquisitions specifically to build the institutional bridge required for whale-tier capital to commit at scale once finality arrives. Metaco for bank-grade custody, standard custody for New York regulated trust services, Hidden Road as a prime brokerage clearing trillions annually, Rail for stablecoin-powered payments, G-Treasury for Fortune 500 corporate treasury management, Palisade for advanced wallet and custody technology. This is not a startup hoping for adoption. This is the steel and cement of the new financial system being poured at exactly the pace required for sustainable, durable. So when does the math collide with the visible market? Pay attention here because the catalysts are no longer theoretical. The Clarity Act reconciliation phase is the immediate near-term variable. Tim Scott's scheduling decisions, the merger of committee versions, the ethical guardrail negotiations, the floor calendar coordination. Every one of these is a discrete, observable event that updates institutional probability matrices. The July 4th political target represents the symbolic best-case scenario. The August timeline represents the institutional baseline. The fall window represents the conservative scenario. All three are within the realistic range, and the market is currently pricing somewhere between them with adjustment as new information arrives. In Asia, Japan's Financial Services Agency has already moved decisively to recognize XRP as a regulated digital asset. The Bank of Japan continues to publish CBDC research that explicitly discusses interoperability layers. The European Union's MiCA regulation is now fully operational, providing the legal certainty European banks have been demanding for years. Each of these is another wall coming down between institutional capital and on-chain settlement. And critically, these other jurisdictional developments continue compounding in parallel regardless of US legislative pace. Then there is the macro layer. The Federal Reserve continues to evolve its posture. A Fed chair transition is approaching that, by every credible candidate's documented record, points toward a more accommodative stance on payment system modernization. Global debt levels are forcing every major central bank to consider new settlement architectures. The IMF has openly discussed the need for a more efficient cross-border framework. Layer on top of that, the rise of AI agents requiring instant programmatic settlement, the SWIFT ISO 20022 hard deadline in November 2026, and the institutional collateral expansion already publicly described by major prime brokerage executives. The fuse is already lit. There are multiple fuses. They are lit in parallel. And the parallel structure means the absence of a single immediate catalyst does not mean the broader convergence is stalled. It means the broader convergence is unfolding across multiple independent timelines simultaneously, with each one delivering its own incremental catalyst over the coming months. Now let me sharpen something else that retail consistently underweights: the ETF, an institutional product pipeline that is being constructed in real time during this pre-confirmation interval. Exchange-traded products have become one of the most important gateways for institutional crypto exposure because they bridge the operational gap between traditional fiduciary compliance and digital asset access. Many traditional investors are not allowed to directly hold digital assets under their existing mandates, but they can allocate into regulated financial products that track them. This bridge mechanism is structurally critical, and it is being engineered into existence right now, behind the visible price action, while retail demands God candles. In this environment, XRP-specific institutional products keep appearing in serious analyst conversations. The combined XRP ETF complex has approached and pulled back from a meaningful threshold level, and Standard Chartered's published research projects significant additional inflows on Clarity Act passage. Stephen McClurg of Canary Capital has been the most analytically specific public voice about the threshold mechanism that determines when major institutional issuers like BlackRock can defensively proceed. The mechanics are documented. The thresholds are publicly identified. The activation triggers are observable. None of this is hidden. It just requires reading the institutional-grade material instead of the engagement-bait content dominating retail feeds. Now let's talk about the side of the equation most people refuse to confront: supply drain. While the demand side is being assembled by ETF custodians, sovereign-adjacent institutional partners, treasury vehicles, AI-driven payment flows, the SWIFT ISO 20022 forced migration, the institutional collateral expansion, and the broader macro liquidity wave, the supply side is being quietly removed from the open market. Exchange reserves of XRP have been trending lower for an extended period. Crypto quant data, Glassnode analytics, on-chain forensic researchers, every credible source confirms the same trend. Tokens are leaving exchanges and entering custody. Once a token enters a multi-signature institutional vault, an ETF custodian's reserves, a treasury allocation, or a long-term holding wallet, it does not come back to market for a 10% profit. It is gone, it is parked, it is reserved for the new system. We are moving from an era of abundance to an era of scarcity, and retail has not priced this in. Think about what that means in practical terms. When the reconciliation completes, when the floor vote passes, when the House reciprocates, when the presidential signature lands, when the macro liquidity wave arrives, when the institutional gates open across multiple jurisdictions simultaneously, the available float on exchanges will be a fraction of what it appears to be on paper today. Order books will be thin, buy walls will be hollow, and the price discovery process will not be gradual. It will be violent, the exact kind of repricing event some analysts have been describing, where the gap between visible price and structural utility value closes in compressed time frames that retail emotional time horizons simply cannot prepare for. The XRP rich list already shows wallets in the shark tier, those holding between 100,000 and 1 million XRP, growing in number through every recent down cycle. Long-term holding wallets sit at all-time highs. The supply transfer from impatient hands into patient institutional custody is not a future event. It is happening right now, in real time, on the public ledger, while retail screams about the missing God candle. New buyers eventually will not be buying whole XRP. They will be buying drops. 1 XRP equals 1 million drops, and over time, drops will be the only unit late retail can afford to accumulate. There is a phrase you will start hearing more often: the great priced out. It refers to the moment when retail realizes the entry price they wanted no longer exists. The window is closing, not in years, in quarters, possibly in weeks once finality lands. The institutions have spent half a decade trying to shake you out so they can take your position. The pre-confirmation interval is the most efficient shakeout tool they have ever had, because retail's psychological need for instant gratification turns disciplined consolidation into a frustration so intense that holders sell during exactly the period when they should be most aggressively positioned. Don't make their job easy. Let me push deeper on the technical structure, because I want you to understand the consolidation phase with the level of detail it actually requires. The impulse move from 151 to 155 was clean. It cleared resistance. It established a new local range. The pullback that followed has been orderly. It has tested previous breakout zones. It has retraced into the 50 EMA region without violently breaking it. Volume during the consolidation has been moderate, suggesting accumulation rather than capitulation. This is the technical fingerprint of a market that is digesting a major macro event rather than rejecting it. The structure is not failing. The structure is processing. Now here is the discipline. The decisive technical question is whether buyers continue to defend the 50 EMA region with conviction. If support holds and gradual volume returns, the next expansion phase becomes the high probability outcome. If support fails decisively and the market loses key liquidity zones, the structure shifts into a deeper correction, with lower liquidity sweeps before recovery. Both outcomes are mechanically possible. The relevant variable is what new information arrives during the consolidation period. And that new information is almost entirely tied to legislative progress, reconciliation timing, and any unexpected macro developments. The technical structure is downstream of the political and macro structure. Charts do not move in isolation. They react to information. And right now, the information environment is producing exactly the kind of mixed signals that produce mixed price action. Another sharp insight retail consistently misses. The bipartisan support that emerged during the markup is, paradoxically, both bullish and slow. It is bullish because legislation that clears with bipartisan backing tends to produce more durable regulatory frameworks once enacted. It is slow because bipartisan negotiation, by definition, requires more compromise, more amendment cycles, more ethical guardrail integration, more language refinement than purely partisan legislation. So the same signal that increases the probability of eventual passage simultaneously increases the timeline to passage. Retail wants speed. The political system is delivering durability at the cost of speed. Those two trade off against each other in legislative reality, and the gap between retail expectation and that trade-off is, again, where conviction collapses. I know exactly what you're feeling right now. You're watching the chart drift sideways. You're watching the political process inch forward instead of sprint. You're watching influencers pivot to whatever shiny narrative is trending this week, because the engagement on XRP God Candle imminent started to fade, and they need new clickbait. You're watching the gap between what you were promised and what is actually unfolding. And the temptation to give up, to convince yourself the thesis is broken, the catalysts are fake, the institutional flood is a fairy tale, has never been louder. I understand that. But my job is to refuse to let you make the most expensive mistake in this entire industry. The mistake is selling during the pre-confirmation interval, because the pre-confirmation interval feels exactly like the thesis failing. That feeling is the trap. The trap is engineered. The institutions need exit liquidity from the impatient to fund the entry of the patient. They need you frustrated, they need you confused, they need you convinced that the absence of a God candle means the thesis is dead. None of those interpretations are correct. All of them are emotionally manufactured by an attention economy that rewards extremity in both directions. Being early feels exactly like being wrong, right up until the moment reality catches up. That is the cruelest psychological trap in this entire industry, and the institutions know it. They are counting on it. They need a steady stream of exit liquidity from the impatient to fund the entry of the patient. Markets reward anticipation, not confirmation. By the time the bill is signed, by the time the ETF flows accelerate, by the time the institutional collateral expansion translates into deployed capital, by the time the swift deadline forces operational integration, the early positioning window will be closed. The patient holders will have already set their floor positions during exactly this consolidation phase that retail keeps interpreting as failure. The late buyers will be paying premiums on a constrained float against fully unlocked institutional demand. Let me make this even sharper. The current market environment is not a problem. The current market environment is a gift. It is the last clean opportunity to position in the pre-confirmation interval before finality arrives. Every previous infrastructure transition in financial history, the internet rollout, the cloud migration, the mobile revolution, produced exactly this kind of pre-confirmation consolidation phase and exactly this kind of frustrated retail capitulation before the eventual breakout that retroactively made the patient holders look like geniuses and the impatient sellers look like exit liquidity. The pattern is documented. The pattern is repeating. The only variable is which side of the pattern you choose to occupy. The combination of the Clarity Act reconciliation progress, the documented institutional infrastructure deployment, the multi-jurisdictional regulatory clarity expansion, the constrained supply structure that continues compressing daily, the macro liquidity environment approaching, the Fed chair transition queued, the swift ISO 20022 hard deadline forcing global institutional migration, the institutional collateral expansion already publicly described, the ETF threshold mechanism approaching activation, the AI-driven settlement demand category forming, the demographic gravity of generational wealth transfer, and the global retail demand pattern compounding across Asia and Europe. All of this is converging structurally during the exact period when retail is most demoralized by the absence of immediate gratification. This is not a single catalyst. This is a multi-front structural convergence operating across multiple independent timelines, with each one producing its own incremental catalyst as the months unfold. The XRP thesis has never had this many simultaneously aligned variables. Not at any prior point in this asset's history. If you've made it this far in the video, you are not the confused. You are the informed. Hold that line. Hold it with the discipline that the institutions hold theirs. Hold it through the consolidation that retail is interpreting as failure. Hold it because the math is on your side, the structure is on your side, the documented institutional positioning is on your side, and the only thing standing between you and the asymmetric upside is your own psychological tolerance for the pre-confirmation interval that defines every major infrastructure transition in recorded financial history. Let me leave you with this, and I want you to take it seriously. The missing God candle is not evidence the thesis is broken. It is evidence the thesis is operating exactly the way major regulatory transitions actually operate. The cooling phase is not weakness. The consolidation is not failure. The reconciliation timeline is not stalling. Every element of what you are watching right now is the documented signature of a market in transition between progress and finality. And that transition is the most asymmetrically positioned window of the entire cycle, hidden under the surface of what feels like nothing happening. The question is, are you watching the chart demanding fireworks, or are you watching the convergence and positioning before the resolution? History does not reward comfort. It rewards those who pay attention when the room is quiet. And right now, the room is very, very quiet. Exactly the way the silent actors building the next system needed to be. While the reconciliation completes, while the institutional infrastructure matures, while the supply continues draining, and while retail keeps selling out of frustration with timelines that institutions consider perfectly normal. If you made it to the end of this analysis, drop the word reconciliation in the comments. I want to see who actually understood what was decoded today. If you value this kind of deep structural breakdown, subscribe and turn on notifications, because the catalysts are accelerating across every front simultaneously, each on its own timeline, all converging toward the same window. The math doesn't lie. The structure doesn't lie. The institutional positioning doesn't lie. The system is almost complete. Stay patient. Stay disciplined. Stay analytically honest. And as we always do, we don't wait for the future. We plan for it. This content is for informational and educational purposes only and is not financial advice. Always do your own research before making any investment decision.